back to JPX Energy Market Weekly Updates. Crude oil futures were lower last Friday amid mild profit-taking, but remain on track for a strong weekly finish as fears the demand destruction insists with oil prices down more than 20% from their June highs. The positive setting in the oil market last week has been aided in large parts by signs of slight cooling of U.S. inflation, which sees concerns of more aggressive maneuvering by the U.S. Federal Reserve and weaker economic activity, and this is followed by bullish reports from the EIA and the IEA. From most October, JPX Dubai futures were trading at equally $91.7 per barrel, while IC Brent were trading at $98 per barrel. However, the backwardation structure of all crude references flattened in the first half of August. Crude oil futures intermonth spreads continued to hover at multi-month lows in a signs of ceasing tightness at the prompt. The first line and third line JPX Dubai time spread was trading at equally $2.9 per barrel, a low not seen since April. On the demand side, signs of strong demand boosted sentiment across the commodity market last week. US CPI data rose 8.5% in July from a year ago, down from June when it surged to 9.1%. On a monthly basis, the consumer price index was flat as energy prices broadly declined 4.6% and gasoline fell 7.7%, according to the U.S. Bureau of Labor Statistics. The report was better than many analysts had expected overall. With inflation slowing and fuel prices falling, fuel demand could continue to fight back against demand destruction going forward. However, that core inflation will likely remain elevated with labor markets still tight and keep the Fed firmly in tightening mode. EIA data last week showing a rebound in U.S. gasoline demand. U.S. gasoline stocks tumbled nearly 5 million barrels even as refiners ramp up as domestic fuel demand recovered and as export jumped to fresh highs. The implied gasoline demand rose to 9.1 million barrels per day, up from 8.5 million barrels a day the week prior, representing a 6.8% jump as the busy summer driving season neared its conclusion. A reason any demand concerns that may have been after the EIA printed the figure below 2020 levels a week earlier. In addition, heat waves are hitting around the globe this summer, pushing natural gas and electricity prices to new records in some regions. Increased oil burns are seen in power generation not only in Europe, the Middle East, but also across Asia. A looming natural gas crunch in Europe is already incentivizing substantial gas-oil demand substitution previously. A number of oil companies, including Shell's Rotterdam and Rhineland refiners, BP's European refiners, and Italy's Eni refiners, said in recent quarterly reports that reducing the use of natural gas. The International Energy Agency, in its monthly oil market report, raises 2022 oil demand growth estimate by 380,000 barrels per day to 2.1 million barrels per day, citing soaring oil use in power generation and gas-to-oil switching in industry. Forward pricing signaled that this situation could persist until at least the end of 2023. These demand gains mask relative weakness in other sectors. Growth is nonetheless expected to slow from 5.1 million barrels a day in the first quarter to a marginal 40,000 barrels per day by the fourth quarter, according to IEA's analysis. On the supply side, world oil supply reached a post-pandemic peak in July amid a strong return from maintenance-related outages. Global output rose 1.4 million barrels per day to 100.5 million barrels per day, the highest level since January 2020, after the North Sea, Canada, and Kazakhstan bounced back from scheduled upstream repairs, and Saudi Arabia ramped up in line with its OPEC Plus increase. Russian supply also edged up marginally according to the IEA's data. From July through December, global production is forecast to grow by 1 million barrels per day to reach 101.6 million barrels per day. Supplies from the OPEC Plus are expected to rise by 400,000 barrels per day over the period, and producers outside the alliance are set at 640,000 barrels per day, with the United States leading the gains. On top of that, Iranian crude is also likely to return to the market in the near future as the talks on the nuclear issue has made relative significant progress during these 2 weeks. In the short term, Shell had ramped up 3 of its oil and gas fields in the Gulf of Mexico after completing repairs to a station in Louisiana that allows key pipelines to resume flows. Multiple offshore platforms were shut Thursday after a leak at Louisiana booster station. However, atmospheric and oceanic conditions still favor an above-normal 2022 Atlantic hurricane season, according to the NOAA annual mid-season update. We're just getting into the peak month of August through October for hurricane development, and it could cause more disruption to oil and gas production in the United States. Okay, that's what I want to share with you today, and welcome back next week.